Welcome and thank you for joining us for today's webinar. For those of you who may be new to Source Advisors, we've been helping CPA firms and their clients maximize federal and state tax incentives for over 40 years. We are headquartered in Arlington, Texas, where we work with accounting firms across the country to deliver expert guidance in areas such as the R&D tax credit, cost segregation, LIFO, energy efficiency incentives, sales and use tax, and property tax consulting. Before we get started, just a few housekeeping items. There will be 4 polling questions during today's session. To qualify for CPE, you must answer at least 3 of them and attend a minimum of 50 minutes as tracked by the presentation software. CPE certificates will be sent via email within 3 business days. Additionally, please use both the chat and Q&A features located in the upper right corner of your screen. If you have a question specifically for our presenters, be sure and use the Q&A panel, as we'll reserve time at the end of the session to address as many as possible. Lastly, the PDF of today's presentation is available for download now. Should you wish to follow along or reference it afterward, you can find that under handouts in your upper right corner. When polling is occurring, please make certain your brightness is fully up so that you can see the tabs next to the polling questions and answer correctly. And with that, I will hand it over to our presenters.
Great, thanks, Ann. My name is Deb Roth. I lead the R&D tax credit practice at Source Advisors. I am accompanied today by Robert Henry Wallace III, and we're excited to present today. I've been in the R&D tax credit field since about 1995, have seen quite a bit in the R&D world, and we're excited to share some highlights today related to the One Big Beautiful Bill and what's happening in the R&D world with elections and everything for your 2025 returns and so forth. So with that, I'll turn it over to Robert for brief introductions and we'll get started.
Yep. Hello, everyone. My name is Robert. Pleasure to meet you all. I've been working in the R&D credit space for about 8 years. Over that time, I've helped out with incentives with clients for the R&D credit space, other energy and credit incentives like 179D and Section 41, 45L. My background is in petroleum engineering, and I take that engineering expertise into the R&D credit space. So with that, I'd like to go ahead and walk through what we'll discuss today. First, we'll do a quick introduction to the R&D tax credit. Next, we can discuss a little bit about the tax credit computation and how it works. Deb will then talk about the state R&D tax credits, the startup R&D tax credits, and a little bit about how the OBBBA effects and election options have been updated. And then I will close things out with changes to Form 6765. Okay, introduction to the R&D tax credit. So the credit itself, just as a little bit of history, was originally enacted in the 1980s and made permanent in 2015. So it is a credit that you can claim going forward year over year. It's found in Section 41 of the Internal Revenue Code. It's a riveting read if you're ever bored or would like to read it, feel so inclined. But as you can tell in the name, as opposed to a deduction, it is a tax credit that reduces tax liability dollar for dollar. It can be claimed on the federal and the state level. So it can be claimed for activities already being performed by various companies. Okay, and then next we have various qualifying activities. I wanted to walk through what a few of those look like. If we're thinking industries, some of the major hitters you can think of are manufacturing, software, architecture and engineering, pharmaceutical, financial technology, and any subset of those industries. And then activities within those industries you can see listed on this page. If you see or can think of any activities that a company is performing that is on this list, it's a good indication that they may qualify for the R&D tax credit. One question that we generally get is, well, we're not doing anything new to the world or the industry, so you may not qualify for the credit, but the discovery rule is actually not something that is currently in place. If it's new to the business or the taxpayer, then it's something that you can look at for claiming the R&D tax credit. So these are some of the qualifying activities: design tooling, prototyping, software development, manufacturing, process development, items like that. Okay. So beyond that, there is a governing criteria for what qualifies for the R&D tax credit, and that is the 4-part test. All 4 elements of this test need to be present for the activities that you're trying to claim to qualify. And I'll walk through them here now. So in the top left, you have the new or improved business component. You can think of this one as what is it exactly you're trying to develop, or what is it your activities are geared towards. So that can be a product, a process, a formula, invention, a technique, or software. And they also need to be for a permitted purpose. So new or improved functionality, performance, reliability, or quality. Those are the elements there for the new or improved business component. When you're developing one of these items, it has to be in efforts to eliminate an outset uncertainty. Some sort of challenge or uncertainty that was present when the project began needs to be present. So that can be regarding the capability of doing or developing something, the method for implementing or designing or creating something, and of course, regarding the appropriate design of what that item could be. When you're going through this process, it needs to be technological in nature. So you have to rely on hard sciences. That means physical sciences, biological sciences, computer sciences, and software development definitely fall into this category. You're going to want to avoid soft sciences. That's going to be sociology, marketing, research, the non-applied mathematics. And then arguably the most important piece of this test is the process of experimentation. It's noted that substantially all of the activities that are going into development need to constitute elements of a process of experimentation. What does that look like? That can be development or one or more hypotheses. It can be conducting experiments, iterative design or development that can be done via CAD or some sort of simulation software, systematic trial and error. It boils down, though, to an evaluation of at least one or more alternatives. Okay? And as a reminder, all 4 elements of this 4-part test need to be present for the activity to qualify. It is worth noting, it's not exactly mentioned on the slide, but there is an additional 3-part test in the event there's some sort of internal software development being developed. It requires it needs to be innovative, there needs to be significant economic risk, as well as not commercially available. That one's a little bit more case by case, so but that's regarding software that's internally used. Okay, now we talked about the qualitative piece. Let's talk about the quantitative piece. This is talking about the expenditures that qualify for the credit. There are 4 buckets that can go into it. There are salaries and wages, supply expenditures, contractor costs, and computer rental and cloud. I'll start with at the top. So salaries and wages, we're looking at the W-2 box on wages. That's a taxable wage being paid out to qualified employees that have time that satisfies the 4-part test. And there's actually 3 levels of research for those types of employees. There's going to be direct research, but there's also, in addition to that, direct supervision and direct support. Now, keep in mind, this is 1 direct layer above in supervision and 1 direct layer below in support. So nothing too far removed, but you can claim supervision and support towards the credit. If you look at the graphic here, you can see that wages comprise the largest piece of this pie. And that's mainly because it's an activities-based credit. And generally, we see that wages are the biggest contributor of qualifying expenditures. For supplies, so you can claim supply expenditures as long as they are used or consumed during the research process. This can include costs for prototypes, fixtures, tooling for some sorts of manufacturers. More importantly, this is nothing capital, so it can't be depreciable in nature. But if it's consumed during the research process, then supplies can qualify, and it can actually amount to a pretty big sum. Contractors, you'll see here that only 65% of the contractor expenditures can qualify towards the credit. There's a haircut because they're an external, right, spend versus employees. So you can see that there's an incentive there to have employees claim towards the credit. But also, in addition to that, you must retain the rights and risk to the research. So that's going to require a case-by-case basis of analysis for the engagements you have with these external laborers or vendors, 1099s, companies. But ultimately, you must retain rights and risk. And then lastly, this is mainly for software developers, we have the computer rental and cloud. This is for the server space that you rent for R&D sandbox development. Think of AWS, Azure, items like that. Those can also contribute a good amount depending on the size of the software development. Okay, and I'll let Deb chime in for polling question 1.
Hello. We're going to start easy this morning with question number 1. How familiar are you with the R&D tax credit? We've got A, I'm very familiar. I have been claiming credit for years, either for clients or for your own business. Decent, I have some experience, but looking to know more, or none, I'm here to learn. While we leave the polling question up, we did get a question in the Q&A, and the question has to do with, as AI is becoming more prevalent, does vibe coding count as software development if the app skills plugin is used for internal use? I always go back to the 4-part test Robert discussed and says, so vibe coding, and I am not a software development expert. I've got others on my team that are and might be able to provide more in-depth answer. But I would say that the vibe coding, because you are using AI to do most of the technical work for you, it's going to be it might not be the actual activity of the actual coding, but it's the technical unknown surrounding the larger aspects of the project. I always go back to that 4-part test. What are my technical unknowns? What am I trying to figure out, resolve, or discover? And am I using a process of experimentation to get there? So if you want a more in-depth conversation related to that, we're happy to have a side conversation with you. But I wanted to address that question since it popped up. All right. Do we have people answering the poll? Hopefully everybody's got their poll answers in. And we will close it out here shortly. I know Anne is looking at the number of people on the call and the number of poll answers to make sure we give everybody a shot at this.
Yeah, we are in good shape.
Okay, perfect. All right. The next slide is really that product development lifecycle. Robert, if you just want to start chatting on that while we leave the poll open for a sec.
Sure. Okay. This is an example development lifecycle for a project. This is in general, and I think it'd be helpful to apply some of the items we talked about before to this development lifecycle. So everything in green that you can see, usually is something we see that can contain qualified activity, and the grayed out pieces are the ones that we want to leave out in general. Obviously, there's unique cases always, but to start at the beginning, there's sales and marketing. In general, the schmoozing, the having fun, going out and getting the deals, generally by itself, without a technical piece, that is something you want to exclude. However, the technical sales piece here also we see identifies some sort of conceptual design to make sure client expectations, specifications are being understood. This is where the foundations for a lot of design are created, and that element of this process actually does qualify. So you can consider this the beginning of the development life cycle. Moving beyond that, and actually as a note here, you can see direct technical support and supervision are usually tied to this piece. Direct engagement generally begins at that research and conceptual design stage. So those technical sales folks will bring or be engaged with or collaborate with some of the more technical, the directly involved employees. And that's when a lot of the schematics, a lot of those conceptual designs get fleshed out a little bit more to maybe get to the stage of signing or finalizing an engagement with a client. And that would be the research and conceptual design stage. Design engineering is usually where that conceptual design is fleshed out. That's where you have your iterative CAD development. You have your, Scrum teams working to work through some sort of software development. In the architecture and engineering world, this is where design development, that stage is generally finalized. As you move forward, there's also the prototypes and samples. So this is where you actually start to have tangible items, materials. Think about the supply expenditures you may be able to claim. This is where those come to fruition. So you start to actually develop and see if you have a viable prototype based on the design and engineering that was done. The last step here in this process that generally qualifies is the testing and validation. Think of quality assurance. Think of ensuring that the product being developed, the process being developed is meeting a particular performance standard, the software meets a particular performance standard. And if there are any issues, and this is important, that you may go back to the beginning of the cycle to then flow back through it to make sure that it works. At this point, there's still uncertainty associated with the development of the product. All of the uncertainties haven't been eliminated. And we assume that after this stage, they have been. So production and manufacturing, this is where you start to scale up, the production begins, or let's say if you're talking software, the environments become live and your clients are able to engage with them. The hard rule here is that if it's ready for commercial production, then that's where the R&D ends. So this would be the part where we would start to tailor off which activities we are quantifying towards the credit. Sales and marketing, right? Marketing, let's say just market research, polling and seeing how the product is doing, even though it may be for some sort of technical purpose, that type of market research is something that is excluded. It's important to note though, and this actually comes up in software a lot, if you have a maintenance, say troubleshooting, in that case, troubleshooting is meant to bring the software back to its original functionality. So that's something we would exclude. But if you identify an improvement, then you begin back at the beginning of the life cycle. So just a quick walkthrough of what that looks like. Okay, and of course, there are always pitfalls, right? You got to keep an eye out for them. The top two here are more tax in nature. The bottom four are technical. I'll go in chronological order, probably should follow the numbers. So usability. It's a tax credit. You want to make sure you keep an eye out for usability. AMT is a concern, but it's worth noting for C Corps or for small businesses under 50 million that the credit can be used and utilized to help offset some of that AMT that would have existed. And also it's a general business credit, so it follows that form 3800. Controlled groups. When we're talking controlled groups, businesses that are under common control need to be evaluated together. And that can be shareholders or owners that have multiple businesses that they own enough of, or if a company owns another company. The reason this is important is because according to tax law, you have to evaluate these companies as one entity. And then you calculate the credit together and it's reapportioned back out based on the contribution of qualified expenditures. So it can have some implications on usability. Acquisitions and dispositions. This is important because you want to make sure you're comparing apples to apples and not apples to oranges. So if you acquire a company that was in existence or you dispose of a portion of the business that has been around for a while, there is a consistency rule that is in place. That means we need to make sure we evaluate the historical base associated with an acquisition or disposition, not just look at it for that year. And we'll talk more about the base here in a bit. Passive shareholders, just as a note, if you have passive shareholders that are involved in a company that's claiming the R&D tax credit, there may be a negative AMT impact based on that. That is mainly due to an amortization piece that's specific to passive shareholders, but it's more case by case. Funded research, I mentioned this a little bit before, but when you're talking funded research, and you can kind of think of folks who have engagements with external clients, executed agreements, the research being done by the person claiming the credit, they have to have economic risk and retain rights to the research. And this is always governed by the four corners of a contract and is evaluated, of course, case by case. Lastly, we have documentation. There's a lot of case law out there that has reinforced the fact that documentation is very important. A lack of documentation can put some credits generated at risk, but the conduct of an R&D study can help bridge the gap on that documentation piece. Okay, R&D credit computation and usability. And Deb, just let me know if I'm moving too slow or too fast. I'm sure I'll keep an eye out for you. Okay, R&D credit computation. So there are two different computation methods. There's the regular credit and the alternative simplified credit. The regular credit, it looks at a base period of either between 1984 and 1988. And there's also another set of base period rules involving startups, which is a little bit more involved. And we won't be looking at that here today, just for the ease of the conversation. But the credit computation itself, we're talking about the equation, is actually pretty simple. The credit equals 20% of whatever your qualified research expenditures are, greater than the base amount. So yeah, it's like only a handful of variables there. And then alternative simplified credit, for this one, this is only looking at qualified expenditures. It doesn't get involved with gross receipts. It's a more simplified credit, as you can tell by the name. And the credit here, the calculation itself, as you can see on screen, is 14%. of the qualified research expenditures greater than a base amount. Okay. Just as a note, you want to evaluate both methodologies, regular and alternative simplified. It's not really a hard, fast rule whether or not one is better than the other in any case. You really want to evaluate that by client, depending on where they are in their R&D life cycle, how many gross receipts they have compared to the expenditures they're claiming. All of that can play a part in whether or not regular or alternative simplified credit method would be best. And as a rule of thumb, if you're looking for that, net federal credits usually average between 6 and 10% of the qualified research expenditures, right? So if you think about dollars, $1 million in QREs can generally equal between $60,000 and $100,000 of federal credit. And 2/3 of the states do have some form of R&D credit, which is good. Okay, the regular credit. This is a snippet of the form. This is the regular credit portion of the form. So Form 6765 is the form that has both methods. However, Section A does cover the regular credit. I'll let Deb kind of go into the elections here at the top in a bit. But the most important pieces I wanted to note here were that the line 10 here says you have to multiply line 5 by 50%. All that means in a nutshell is you have to make sure that you don't, there's a limit to the amount of credit that you can claim based on the base amount. And I'll actually click the next slide so you can see that. The second bullet here is the point I'm trying to make. The base amount can never be more than 50% of the qualified research expenditures. And all that means is that delta that you're trying to see, the current year expenditures minus your base amount, it can never be less than 50%. So you can think about it as a cap, right? You can't reduce your base so much that your credit is much larger. There are requirements for the historical base in the 1980s sense. You have to have gross receipts and qualified research expenditures prior to 1984. And at least 3 of the 5 years need to have both qualified research expenditures and gross receipts between 1984 and 1988, those 5 years there. And you can see the calculation there for the fixed base. It's the aggregate of QREs divided by the aggregate of gross receipts. Okay, and then there's the alternative simplified credit method. This one is, this is the form here. You can also see that there is a similar calculation. I didn't mention on the other one, but the 280C election is the bottom election there. That helps you identify whether you want to take the gross credit election method or the 280C election method, which prevents the need for an add back of the gross credit. And there are 2 ways to calculate it. If you have at least 3 prior years of qualified expenditures, then the base amount is 50% of the average of the prior 3 years expenditures. And then it's 14% of how much the QREs, qualified research expenditures, exceed that base. If you do not have at least 3 years of qualified expenditures, then there's actually no base calculation at all. And the gross credit is just 6% of the current year's qualified research expenditures.
I'm wondering, Robert, if we talk about, because I recognize in some of these slides, we haven't really touched on 280C, and 280C is going to come up later in our discussion when we talk about certain potential elections for certain taxpayers. But on those forms, one thing as a tax preparer that you should always be considering is whether or not a client should be taking that reduced credit election, which is 280C, versus the gross credit. And you elect that either under the alternative simplified credit or under the regular method. So that is one election that is pretty critical in making when you go about filing your R&D tax credit forms. Some things to think about is you either take the gross credit, and in the environment of amortization, so for 22, 23, and 24, when we had amortization, there was a rule that you added back to income the amount of the credit that was in excess of 10% of your QREs. So in general, many taxpayers did not have that add back to income. and they could take the gross credit without really reducing it by any sort of significance. When you take the 280C credit, you don't have that add back to income. You just automatically take a 21% haircut on your credit value. And so normally in the environment of where we had amortization, 22, 23, and 24, most of our clients were taking the gross credit, where prior to that, 90+% of our clients were all taking the 280C reduced credit. Therefore, they didn't have the add back to income. It didn't affect their, taxable income that went into the state returns and computations, et cetera. So I just wanted to throw that out there. Sorry.
No, thanks for adding the point. Okay, and then credit usability. So R&D tax credits, they are not refundable. So you do need taxed to be able to utilize the credit. Keep in mind the same rules for ANT I mentioned earlier apply. C Corps, smaller businesses can use the credits to offset below that AMT amount. Also worth noting, you can carry it back 1 year and forward 20 years. It follows the general business credit rules there. And in general, you can amend up to 3 years from that date of filing. So a historical look back study can be done where you can amend for multiple years of credits at the same time. Okay, and I will hand it off to Deb for the state R&D tax credits and the credits for startup companies.
All right, perfect. You'll all know a little bit later. While I wanted to make sure I made that 280C point. I like to talk with my hands, and I'm kind of a little bit. I don't know if you can see it because of the screen here, but I have a cast on one hand. So if you see something weird kind of floating into the camera, it's just because I'm a little bit. I got a broken wing at the moment. So anyway, states that offer R&D tax credits. This is a map. The map can be found on our website as well. Many states have R&D tax credits. Some states, the R&D credit is going to be more favorable than the federal credit. So definitely something worth considering when you're filing. You also have the same potential pitfalls. You want to make sure that you have the proper documentation, and then usability. Each state has different usability requirements. Some states don't allow credits for pass-through entities and individuals. And some states have an application process or an application deadline. So you want to make sure that you're aware of all those. When we perform studies for our clients, generally the states are assessed as well and are included as part of that package. So we just wanted to throw out those state credits for you there. There is a second kind of subset of credits. Now, the regular federal R&D credit, when we talk about usability, it's saying you have to have taxable income in order to offset the tax with the tax credit. If you are a startup company, you are allowed to take the R&D tax credit that gets computed the same way, but you elect to treat it as a payroll tax credit offset instead. And it can offset up to $250,000 of the employer's share of payroll taxes on the Social Security tax, and then also $250,000 associated to the Medicare tax. So if you think about it as a startup company, you're generally not in a tax-paying position. In order to qualify for the payroll tax credit offset, you do need to be a young company. You can't have more than 5 years of gross receipts history. Okay. And you can't have more than 5 million of gross receipts in the current year in which you're claiming the credit for. So if you're a 3-year-old company, and gross receipts, unfortunately, also include some of that interest income and all of that. So some companies get tripped up because the first year you may not have any sales per se, but you have interest income from, bank deposits, et cetera, that can impact your gross receipts timeline. So just be aware of that as well. But basically, almost any entity can be a qualified small business, a C Corp, an S Corp, or partnership. And you want your gross receipts to be less than 5 million, and you can't have more than 5 years of gross receipts history. You go through and you compute the credit. The credit is then, if you have excess credits, you can determine, once you compute your credits through the regular credit computation methods, you can then determine how much of those credits you want to go to payroll tax versus reserve for income tax. So if you are a startup and you are profitable, you may want to put some of it towards your payroll tax and some towards your income tax, because you don't want to put too much of it towards payroll tax if it takes you too long to use that up, because you do have to offset your future payroll taxes by the amount of the credit. And if your payroll isn't very high because your research expenses are coming from supplies or contracted costs, it might be better for you to actually put them into an income tax offset bucket as opposed to the payroll tax offset bucket. Once you file your return, that credit can be applied in the first calendar quarter after you file your return. So if you file it on March 30th, you can then apply your payroll tax to your Q2 filing. If you file it April 1st, then you have to wait to Q3 before you can actually use those credits. And control groups also apply here as well. You can't have a company that's starting up a secondary business, calling it a startup, offsetting payroll tax, and still have other entities that are related that have a longer history. So there are certain requirements there. When you do file for the payroll tax credit offset, you want to make sure that you check this box on the R&D tax credit form. If you forget to check this box, then you lose your ability to take the payroll tax credit offset. It has to be done on the originally filed return. Okay, so you go through there, you put it out there, and then you decide, enter the portion you want going towards payroll tax. And then it will go towards your payroll taxes, and then the rest would go towards your general business tax going forward. All right. Let me go forward here. Okay, polling question number 2. I didn't want to have a trick question in here. That's why I had to clarify those two ADC elections. So polling question number 2, this should be launching, and you're going to have, what are the most important elections not to miss on the R&D tax credit form? A, the 280C reduced credit election. B, if you're a startup, to make sure you check that payroll tax credit election box, pretty important. Both are important. Or it doesn't really matter, tax is easy, I can always change my mind. Trying to make at least it easy on some people. So give everybody a chance. This is polling question number 2. We have 2 more coming up before we get to the end of the hour. Reminder, you've got to do 3 of the 4. So if we go ahead and get that going on, that's great. While we're waiting for that poll, I'm going to kind of just get a little started on what our next topic's going to be. We're going to start talking a little bit more about what the One Big Beautiful Bill did related to Section 174. As a refresher, the R&D tax credit is Section 41. The 174 code section says that certain costs have to be research and experimental. And then you look to Section 41 and say, Section 41 costs need to meet the 174 definition, plus there's these additional requirements. So Section 41, which is the research credit, is a smaller subset of costs that lie under the Section 174. All right, so we'll see this here. I think we'll be done with the polling questions. Hopefully people, Anne, or we look like we got pretty good participation there?
Yes. We're all set.
All right. I wish I could see the answers. I always like seeing the answers, but okay. Okay, let's go to the next slide, which is One Big Beautiful Bill. We'll talk about the act. As I was talking about, there is a difference between Section 41 and Section 174. So Section 41 is the R&D credit. Robert went over all of those 4 components that make up those costs. 174 just takes all those costs and then adds on additional labor costs from additional people that may not be doing core R&D activities, but are somehow ancillary to the process. They also pick up additional materials. There's depreciation in there, patent cost, and then overhead allocations are also in there. So just keep that in mind, because I know we've all just come through a period of where we've had to amortize those 174 costs for the past several years. And now with the One Big Beautiful Bill, we have changes to that amortization. When we look at 174, the Act created an entire new code section called 174 Cap A. And this is related to domestic expenditures only. And the old 174 is now related to foreign. So the 174 kind of stayed intact and said that foreign research will still be amortized over 15 years. So that is still in play for federal purposes. And now we have 174A that says you can elect on your 2025 return, any taxpayer can elect on their 2025 return to adopt 174 Cap A and start immediately expensing R&D tax credit expenses again. There is an election statement you are supposed to include on that 2025 return. It isn't a 3115. You don't have to go through a 3115, but there is a statement that needs to be included that says that you are electing 174 Cap A. In addition to that, and that's for all taxpayers, in addition to that, all taxpayers can also accelerate any unamortized amounts from 22 through 24 in 2025, or they can accelerate them pro rata, half in 25 and half in 26, or they can just continue the regular amortization. We'll talk about that as also an election statement. If you're an eligible small business, you also have a little bit of a more favorable options related to you. You may elect to retroactively adopt the 174 Cap A. So you can now go back and say, as if file your 2022 return as if amortization was not in existence for you, you would deduct and you would then claim your R&D tax credit. So we'll talk about that. In the next several slides, we go through each, we do large taxpayer that was compliant with amortization. We do a large taxpayer that missed amortization. We do small taxpayer that did and small taxpayer that did not. So that might help clarify things here kind of step by step. When you're talking about the large taxpayers, if you have been amortizing, you continue your amortization through 2024. There's no relief for you until 2025. So any fiscal year filers out there, unfortunately, you're still stuck with amortization on those 2024 returns. You can expense in 2025 and forward versus with an election statement. And any unamortized amounts, you can make an election on your 2025 return and you confirm what you plan to do with those unamortized amounts. If you're going to flush them all the way through on the 25 return or do them half and half, 25 and 26, or you can not make an election statement and you can just continue with your amortization schedule. We see certain clients obviously working with their CPAs to understand what is my tax position if I try to, accelerate them all in 2025. Am I going to put myself in an NOL and then have NOL limitations going forward? What impact is it really going to do for me? So definitely there are other tax situations and tax impacts you want to evaluate before you make that determination. If you are reverting back to full expensing in 2025, when you compute the R&D tax credit, most companies are going to benefit most from making that 280C election again. However, if you are doing a significant reduction of your tax liability because you're flushing through a lot of those unamortized costs, you may want to take the gross credit election because that will reduce your deductions by the amount of the credit. So that'll help you minimize any potential NOL situation. So it is definitely worth a conversation. We're happy to help you with any of those conversations. Many of you, I'm sure, are working with one of our business development individuals. They can hook you up with whatever kind of conversation you need. Just feel free to reach out to them and they can get you on the calendar. Large businesses that have not been amortizing, and there's a number of them, and a number of them miraculously had R&D up through 21 and then stopped having R&D for a few years and now have R&D again. And so these situations are very common. So if you're falling into one of these that might not have been as compliant as maybe you could have been, you are not alone. So large businesses that have not been amortizing, there is no cure to fix the 174 issue on 22 through 24. So there isn't any way to fix that. So it's done. You move forward. The R&D tax credit is still available for you for those 22 through 2024 years. That's a permanent benefit. Your 174 costs is really a timing issue, right? So the best message for compliance at this point is to, we would say, is to take the credit still in those prior years, if you haven't, and then in your current year on your 25 return, we advise you to make that election to fully expense any unamortized amounts. You don't have any at this point in time, but if the IRS were to come back and audit your returns for those period, at least that would stop the clock on any non-compliance, because you would have flushed all your expenses through on your 2025 return. So we would suggest that, and then make the election statement in 2025 as well to adopt 174 Cap A. Hope that's clear. This stuff gets a little confusing. Okay, now if you're an eligible small business and you have been amortizing under Section 174, you can go back and you can amend your 22 through 24 returns and adopt 174 Cap A retroactively. So if you were a small business, an eligible small business is less than 31 million in gross receipts. And this is just gross receipts line, I think it's 1C. So it's just your gross minus your returns and allowances. That's your gross receipts number that you look to for these purposes. So you would look and see if you're under 31 million average for your prior years. And if that is true, then you qualify as an eligible small business. You want to then, again, it's important to look at the full tax situation of where you are, determine whether or not it's beneficial for you to go back and amend those 3 prior years. If making the retroactive election, it has to be done for all 3 years. So you have to make sure that your 2022 statute is still open. And you have to have made that election from 1 year from enactment, which is going to be 7/6 of 26. So you have about a month and a few days here. If you do have a small business and are looking to go back and amend and your 2022 return is still open, I would strongly encourage you to get with whoever is helping you with that and get on the calendar. We still have capacity to help clients meet that 7/6 deadline if they do want to go back and get compliant. Okay, so if you have been amortizing and now want to go back and reverse the amortization, deduct currently, and true everything up, you do that. You make that through an election statement that you include on your 2022 return, and then you also amend for 23 and 24 with the same process. You have to do this prior to the expiration of the 2022 statute or 7/6. That's pretty important. And you would just have full expensing. And then again, in 2025, you make the election to also adopt 174A. I don't know that that's really necessary, but to be safe, I guess you could make another election because you're already adopting it for 22 through 24. If you decide not to make the retroactive election and you're just going, you can either go through your normal amortization with those prior years, or you can also flush them through in 25 or 25 and 26 pro rata. Okay, so that's for the small business. If we look to the small business that has not been amortizing, and interestingly enough, this group is the luckiest group because they can cure any non-compliance, and it's pretty painless because they don't have to go back and amend and now they have to amend, but they amend with just an election statement saying, hey, I deducted already, but now I'm going to officially make it official that I'm filing 174 Cap A, and nothing really changes on the return from a deduction perspective. At the same time, they can go back and claim the R&D tax credit. And when you claim the R&D tax credit on these amended returns, the small business is also able to take the 280C election, so it won't impact any of your state filings. Okay, your taxable income is not going to change, therefore the state filing should be okay for this group, because they never amortized in the first place. And again, that deadline is 7/6 or the 2022 statute, because it's all or nothing with these years. This election will allow you to have full 174 expensing from the beginning. So all it's doing is it's affirming your original treatment on that return. And then you would just attach that statement to your 22 through 2024 amended returns. And I'm happy to, I don't see any other questions let me see. Oh, yes. So I would say sample statements, we do. And we have those through our business development people. So if you want to reach out, if you don't have a contact within our company with a business development person, please reach out to me and I'll get you set up. But we do have that, and we do want to make it easy for our CPA partners to get those elections on those returns, and we're happy to assist. We have templates, so you have to do a little bit of homework there, but we definitely have templates for you. Okay, where are we coming up? Polling question number 3. All right. Has the treatment of 174 expenditures influenced your decision to pursue R&D tax credits? Yes, dramatically, just slightly, or no, not really. I have seen clients across the board. We've had a ton of dramatic shift. That was a super painful rule. It was obviously horrible tax law, and it was super painful and almost detrimental, bankruptcy type stuff for some clients. So I think most people were probably dramatically impacted. Whether or not that influenced how they pursued their R&D tax credit, it's just more of a inquire of us. So yes, or just slightly, or no, not really. We'll leave that up for just a second. And then I think we're going to go into, I got the slides over here on the left, so I know where I am. We're going to go into the form sections next, I think, team.
That's correct.
All right. Well, I'm going to flip the slide forward, at least for now.
Sure.
And we'll let Robert take off with the changes to Form 6765 as we close out our hour here.
We have a few content-bearing slides left, so we won't eat up too much more of your time. But I do want to go over the changes to the Form 6765. So looking at this, these were changes that were originally proposed in 2023. Some of the changes are currently active now, and some of them are still optional, and they will be required for some businesses beginning next year. But as of right now in 2025, there's a few preliminary questions before Section A, and that's where you find the controlled group question. There's an election there to determine if you are a controlled group, and there's also where you find the 280C election box. So there's Section E and Section F. There's a couple more sections, but let's start with these two. Section E is looking to gather some additional reporting on the company's R&D activities. So if you go through this bulleted list here, they're actually asking for the number of business components that you are claiming expenditures for, right? That's each of those products, each of those processes, each of those softwares. They're looking for the number of those. So they're also looking for officer compensation. Officers for the company that are qualifying towards the credit, those QREs from officers. They're looking whether or not there's acquisitions, dispositions, whether or not you're claiming any new categories of expenditures, right? So if you're adding in supplies this year or adding in contractors where you hadn't before, there's now a requirement to state that you are doing so. And there's the use of the ASC 730 directive for tax-heavy assets over $10 million. Section F is moving into more that's where you find the breakdown of QREs. This part you might have seen in the prior form where they're asking for the number of supplies, the number of wages, the amount of contractors that was listed prior as well. But now they're actually also, this is where you elect to, if you need to complete Section G or not. This is additional reporting. It's important to note here, and I'll kind of go into this more in Section G, that contemporaneous documentation of your research activities year by year is becoming more and more important. If you remember the form from before, this is a significant jump in the level of detail. Even just Section E, they have the number of business components, the amount of officer compensation that's going towards the credit. This is a very big jump in what they're looking for. If you conduct the studies contemporaneously, then this shouldn't be too much of a problem, but it's important to do so. Section G. So this is optional for everyone in 2025, thank goodness. For 2026, it is expected to be optional, except you don't have to do 2026 if you are a qualified small business taxpayer claiming the payroll credit, or both of these criteria are true. You must have qualified expenditures equal to or less than 1.5 million, and that's at the control group level. And you must have gross receipts less than or equal to 50 million. If you're in one of those categories, then the Section G remains optional for you. Lucky you. But otherwise, you'll have to start filling out a little bit more information, which I'll show you now. Here, so the biggest thing here is a itemized listing of the qualified expenditures by business component up to 80% of your total QREs. And that is in descending order. So the greatest, whatever a business component contained the greatest amount of qualified expenditures will be listed first, all the way down until you reach at least 80 or 50 of your business components. So they're looking for a little bit of information there if you're completing Section G. They're also looking to identify what type of business component you are listing. So if you have a project listed, you need to identify whether or not it is a product, a process, formula, invention, software, or technique. For software, they're looking for whether or not it's internal use, dual function, not internal use for commercial sale, or if it has some sort of exception from the internal use software treatment. You need to identify on Section G what information is being sought to be discovered. So you need to talk a little bit about what uncertainty was present associated with these business components, and a breakdown of supplies, computer costs, cloud computing by business component. So it's not just a total amount for supplies. You actually have to list how much of these expenditures for supplies go towards each business component. So completing Section G is more involved than what you may be historically used to. However, conducting studies, especially once we do it, source advisors are a great way to make sure that that bridge is crossed before you realize the bridge is there, right? Okay, told you to be quick. Polling question number 4. Based on the discussion today, are you or your clients thinking about amending prior years to claim missed R&D tax credits? Yes, no, or no, but will likely claim prospectively. And Deb, do we have any questions in the chat? Oh, I think you might be muted, Deb.
Where can we find the source of small business gross receipts test for line 1C?
I'm sorry, Anne. I missed that. I was muted. I was trying to talk. I don't. For some reason, I lost the questions on my right side. But if you want to reread that, Anne, that would be helpful.
Absolutely. Where can we find the source of small business gross receipts test for line 1C?
Okay. Oh, it's actually it's in a whole different section of the tax law that's more on definitional related to it. It is some gross receipts that's then been indexed for inflation. And by the time you get to 2025, the number is 31 million. So I'll have to pull that out from somewhere. I don't have it off the top of my head. But it's some other definition within the tax code. But we can get that over to whoever requested that. There was also another question on, is there a 3115 needed to fully deduct the unamortized 174 costs? And no, a 3115 is not needed. The actual form 3115. So when I talk about this, the form 3115 is not needed, but there is an election statement that acts as a 3115. So you do need the election statement, but then the treatment is treatment. I think the question was, does the deduction of the unamortized 174 cost count as amortization expense? And can it be added back for computing adjustable taxable income under the 163J limitation? And the answer to that is also yes.
Great. We also have a question. Can you clarify how startup benefits from R&D, can you clarify how startup benefits from R&D credit?
So startups will benefit from the R&D tax credit by, if they don't have taxable income, they offset their payroll tax. So if you're paying $1 million in payroll to your people to work on development or just work on production, it doesn't matter. It doesn't have to be related to the R&D credit. If you're paying $1 million, you're paying, I think, 6.2% in Social Security, employer covered Social Security tax. So that would be $62,000 of tax you'd be paying as an employer. You would use the R&D tax credit to offset that $62,000. And it can also offset the Medicare, the employer portion of the Medicare tax, which is the 1.45%. And you include that on your 941s through your payroll tax credit provider.
And there's one last question.
Okay.
Can you explain the what the add back would be to taxable income if you do not elect the Section 280C reduced credit?
I can take this one. So for this one, when you take the gross credit, you're also entitled to deductions for the expenditures that you claim towards the credit, right? So when you take the gross credit, you would just reduce the amount that you're deducting on the qualified research expenditure side by the amount of credit, and that's as simple as it gets.
That was our last question, and our last poll looks like it was very evenly divided between A, B, and C.
Thank you. Well, thanks everyone for joining us. We appreciate it. We hope you got some good information. Feel free to reach out. Also, if you do have a business development contact, they are going to be the easiest to reach, and we'll pull whoever their technical contact in to help you through all of these discussions. Robert and I are definitely here to help, and we have a whole team ready to help everybody through all these conversations. So thank you so much.
Hey, Deb, there's one more question that snuck in. I figured I would ask it. So the question is, can an acquiring company have startup benefits from R&D? Can an acquiring company benefit from the R&D startup situation? I think is what the question's trying to read.
If somebody acquires
benefits from R&D of
a startup, I think you're going to have the same normal limitations you have when there's some sort of a transaction, and that's a whole other limitation. But I would say that if the acquiring company pushes that startup greater than 5 million and longer than a 5-year history of gross receipts on that next year's filing, then they're not going to qualify as a startup anymore. But if there is payroll tax credit, tax credits that are sitting on a startup company's books that haven't been used yet, and they're going to be using them, somebody comes in and acquires, those would be used just like any other credits that get acquired during some sort of a transaction like that. There could be limitations there. All right. Top of the hour, I think. So thanks, everybody.
Thank you, everyone, for listening.